All right. I'm going to give it 1 second for folks to actually get on. I'm watching the participants' numbers tick up as the system lets people in. So we'll give it 1 more minute and then actually get started.
Hey, Senator Brown, could you scoot back maybe 3 inches?
Yeah,
A
I can do that. Yeah, I already scooted back some, but is that better?
Yeah.
Perfect.
Okay. I think we should get started. So I'm Lisa Donner. I'm the Executive Director of Americans for Financial Reform, and I want to thank everybody for joining us today. So this afternoon, we are marking the 10th anniversary of the Dodd-Frank Financial Reform and Consumer Protection Act with a conversation about what changes are needed now to build an economy that works better for most people. And we're incredibly fortunate to be able to do that with these remarkable leaders and thinkers. Senator Brown of Ohio is the ranking member of the Senate Banking Committee and does such an incredibly powerful job of making clear the connections between what happens in the financial system and what happens or doesn't happen in the lives of working people, upholding the powerful to account and advancing an agenda for justice. And it's a great privilege to get to talk with him about this afternoon.
Thanks, Lisa.
Professor Hamilton is the Executive Director of the Kirwan Institute for the Study of Race and Ethnicity at Ohio State University. He's an economist who focuses on the causes, consequences, and remedies of racial and ethnic inequality and asks important questions and pushes for bold solutions. And I'll also add that he's a member of the AFR Education Fund Board. Before we begin, I just want to note that immediately after this conversation, with just 1 moment for technical switching, we'll have an excellent panel on very similar themes, and then a final conversation digging deeper on one idea, a public option for financing for the public interest. All right, so with that, just to get the conversation rolling, so the financial crisis of 2007 that Dodd-Frank responded to demonstrated that banks and financial markets were structured in a way that incentivized excessive risk-taking, privatized gains and socialized losses, and led to the financial sector driving the real economy into a crisis that had terrible, terrible costs for many millions of Americans. This crisis that we're in now, the coronavirus crisis, has different roots, but its impact has really highlighted fundamental underlying economic and racial injustices and made it particularly clear that the current financial system isn't set up to help create a just or equitable economy. Could you each talk a little bit about what you think makes that the case and why? Maybe starting with you, Professor Hamilton.
Well, first, thank you for this forum. And, I can't think of 2 other people I would rather be talking about this subject with besides Senator Brown and you, Lisa. And you are right, this recession is different. This recession is not the result of some incongruity with asset prices and market fundamentals, but rather, or something that's generated by a speculative bubble, but rather we made the moral decision to save lives and to hibernate the economy. And therefore, we literally had an abrupt stoppage of transaction that has generated this recession. Likewise, the public response needs to be, in this scenario in particular, to try to keep workers in place best they can, keep aggregate demand up best they can. I know that Congress now is considering the next iteration of interventions. And if we do not act, we run the risk of spiraling into a depression, and we really can do something about avoiding that depression at this moment. But that said, we still have the scenario where we're very vulnerable to the financial sector. I think Dodd-Frank was a good giant step in providing some protections, but the reality is that this is really about power, and the financial sector has a great deal of power that leaves, in particular, workers that don't have finance to the extent that some might have, that have limited wealth, and that don't have political power or stigmatized by race, you know, that trifecta of lack of political power, economic power, and the ways in which we stigmatize marginal groups leaves them vulnerable to predation, vulnerable to extraction. So again, what I led off with is talking about a need for public power interventions to protect workers and protect marginalized communities. And likewise, even when it comes to finance, we're gonna need some public interventions to provide direct alternatives so that everybody has adequate access to an account to finance so that they can partake in an inclusive economy.
Dr. Hamilton, thank you. And Lisa, thanks for having us and having the Ohio, Dr. Hamilton and I. It's nice to be with another Ohioan, one especially as smart, as articulate and brainy on all these issues as Dr. Hamilton. And Lisa, thank you for your public interest work for so many years. I was listening to Dr. Hamilton talk about that. You know, we passed, I was on the banking, you know, it's referred to as the banking committee. I like to call it the housing and banking committee. It's the committee really is banking, housing, and urban affairs, but we don't do nearly enough in this committee about housing. That will change. I'm hopeful in 2021, perhaps more on that later. But when we passed Dodd-Frank, it was, we passed it to prevent another financial crisis, but that's really the bare minimum. I guess it did prevent another financial crisis, but income inequality got worse, racial disparities deepened. We know from this pandemic, the pandemic, many have called it the great revealer. It's revealed racial disparities. It's revealed the holes in our safety net. It's revealed so much to us as a nation, and is a call to action for what we need to do next. But we need to, you know, preventing the next economic catastrophe is obviously something that Congress has an obligation to do, but we should aim higher than that. We should aim higher in terms of wages, higher in terms of affordable, accessible housing. We've got to start thinking, is this the best we can do? And it isn't. And it isn't, it wasn't with Dodd-Frank. It was major, it was a positive step for sure. But since then, we've seen corporate profits up. We've seen stock prices soar. We've seen executive compensation explode. When I was a kid, I think the ratio of CEO to average worker was 25-1. Today, that ratio is at least 250 to 1. More than a quarter renters before the pandemic paid more than half their wages, half their income, whatever their income was, paid more than half their income for housing. So one thing goes wrong in their life, the car breaks down, their child gets sick, they get a workplace injury that keeps them out of work for a few days. The world turns upside down for them. So we need to think about this as we celebrate, if that's the right verb, the passage of Dodd-Frank, again, against the resistance of Wall Street, against virtually every Republican in the Senate and House. We've got to think, how do we raise wages? When companies raise wages, Wall Street punishes them. How do we turn that in a different way? When companies lay off workers, Wall Street rewards them. And this is not an economy. This is an economy that doesn't serve average people. It particularly doesn't serve, it betrays in many ways people of color who have worked hard and have so little to show for it as many Americans do. And many Americans are in that quandary. So let me ask Darrick a question about sort of, if we can kind of go back and forth this way, Lisa, how do we, one of the problems with the Wall Street model is how we measure the economy. So we certainly have a president that measures it only by the stock market. That's all he cares about. In fact, his irresponsibility and ineptness and so many other things dealing with the coronavirus is in part because he's always focused on the stock market. What do we do to measure the economy different, Darrick? What kinds of things should we be thinking of?
And I like how you juxtapose Wall Street values versus perhaps what the government should be thinking about their values. I mean, Wall Street is a for-profit entity. So their values and their measurements come down to just that, trying to generate profits for their shareholders. But the American government has a different set of priorities. The priorities for the American government should be its people. That's its fiduciary responsibility. Its fiduciary responsibility is to the social welfare of its people. And likewise, the measurement that we use to measure social welfare obviously should extend well beyond profits. I think a well-functioning economy is one where it is providing the structure, facilitating people to be their best selves when people have authentic agency. So for example, I know we're going to talk about this a little later, your bill to provide and make sure that everyone has an adequate account, that's an example of a measure that I think we should be looking at to determine how well we're doing. Does everybody have an adequate account so that in the 21st century, they're not vulnerable to predatory interest rates or predatory fines and fees if they have overdraft? So, broadly speaking, I think we need to come up with measures that measure our shared prosperity, that look at what Amartya Sen, the economist, and others have described human capabilities. If we really can figure out ways in which not only do we focus on GDP, but GDP distribution, right? It's one thing if we have growth and all the growth is going to the top, which has been the case. It's another thing if we have growth that is promoting our shared prosperity. That's what we need to be focused on.
Lisa? No.
So I guess the current, you're both talking about the fact that the current financial system doesn't help address these broader economic problems that as you both said, have become so obvious in the COVID crisis. And in many cases actually makes them worse. It drives inequality, it sucks resources away from most people to those at the top, and perpetuates and amplifies racial injustice. Darrick started to talk about this a moment ago, but what kind of solutions do you think would change this and start making the financial economy work for the rest of us in the real economy?
Well, we first should look at, thank you, Lisa, for that. We first should look at the banking financial system as a public good for everyone. We know it already is for corporations. Dr. Hamlin just said a moment ago that one of the proposals about everybody having access to the system, when a professor at Ohio State or a U.S. senator has money, they deposit in a bank and they get paid by not much right now, but they get paid by the bank for their money. If you're living in an apartment and you can barely afford to pay your rent, you go to a payday lender and it works just the opposite. You pay a fee for everything, to banks, to cash checks, and with your wages are already low, you're in a deeper hole. We have, that's compounded by having centuries of systemic racism built into the financial system. So whenever we try to, we have no problem, Congress has no problem intervening in the economy to save corporations and generally the white men who run them. But when we try to fix this economy for everyone else, whether it's a minimum wage increase, whether it's fixing the overtime rule that this president took away, those same CEOs and their representatives in the Senate call it meddling in the economy, saying, no, we can't do that. We can't, that's not capitalism. That violates the free market. So we need to rally people around, because most of our country understands dignity of work the way Dr. Hamilton and Lisa and I understand it. And that is that you work hard, you should get an adequate living, you should get adequate pay. You should be able to afford a clean, accessible, decent place to live. You should be able to take care of your children. And when the right wing makes it look like people aren't working hard, those are the people that work the hardest. I ran into anybody because it's all by phone and remote now, but I was talking to a grocery store worker in Southwest Ohio maybe 3-4 weeks ago, and she said, they call me an essential worker, but really I'm expendable because they don't pay me much and they don't keep me safe at work. And this, when I said earlier, this pandemic is the great revealer. One of the things it's realized is who's doing the essential work in this society. It's mostly women, it's disproportionately people of color, and it's people that generally aren't compensated very well. And that's our challenge in the years ahead. How we reward work. Call it the dignity of work, call it rewarding work. How do we reward work so that people that work hard really can get ahead regardless of their skin color, regardless of their gender, regardless of their place in life?
Yeah, I mean, a lot of this is about power, and that's what Dodd-Frank intended to address, to rebalance concentrations of power that not only left individuals vulnerable to predation because of inordinate amount of power, but our whole economy vulnerable to speculative notions and things like that. But in this rebalancing of power, I think there's a need for direct action on the part of government to make sure that people aren't at the whim of monopoly power. And this doesn't exclude the private sector. The private sector should be part of our economy, of course, but they should engage with workers that are not completely at their whim. So to be specific, things like a credit score, if it is at the discretion of the private sector and how we measure this, who has access to it, and what it is used for, that's a problem. If I'm applying for a job that has nothing to do with my ability to, whether I owned a house and was paying a mortgage versus paying a rent, that should not be a criteria by which I get selected for a job. So when we think about how we're gonna rate people, we need to not only have it transparent, we need to make sure that these ratings aren't just recreating and reinforcing inequality, that those that have get rated better and therefore are able to get more on less costly terms than those that don't have. That's a problem, and we need government to rebalance that. We need to make sure that there's access to capital, and that is very American. So, if we think about our history, America seeded a middle class. It seeded a middle class with direct grants of things like GI Bill, Homestead Act. Of course, we would want to do it differently this iteration. We'd want to do it in a way that's inclusive of all racial groups, so we don't have a Faustian bargain where we compromise the political inclusion and economic inclusion of Black people to get it legislated. And I think we're in that moment. I think we're in that moment with protests saying Black Lives Matter that are coming from all walks of society. We're in that moment to recognize that this iteration of an economic rights should be actively anti-racist, anti-sexist, and ensuring that everyone is included. I think this is what we need. I have one last point and then a question for the senator. And, the senator brought up how the other side talks about the role of markets in facilitating a dynamic economy that's supposed to trickle down to all of us. Of course, we've had 45 years of both that rhetoric and that policy, and what we've gotten was gross inequality that hasn't been replicated since the Great Depression. So the promised trickle down has never been delivered. But nonetheless, the notions of what markets are supposed to deliver, I'm curious, especially in the role of finance, about information, about, is there, we often have these narratives about why do poor people engage in, they're vulnerable because they lack financial literacy. But is it the case that there's equity with regards to engagement on things like information? And if not, how does that relate to transactions, and what should we do about it?
Well, think about privacy for a moment, and how when you sign up for anything, you sign away. Who reads 20 pages of small print on privacy information that you're given by the company to get a credit card or to buy a card, to do a whole bunch of different things, and you're in essence signing away your rights without really knowing it or without really thinking about it. We've got to. That you start with that, but you had said something earlier that made me think about how important it is to use the institutions in our society now to level the playing field for moderate and low income people. Things like the Postal Service or the Federal Reserve. I mean, the Federal Reserve, you grow up thinking the Federal Reserve. I mean, I grew up when it was, I think by then it was Alan Greenspan and the wise, the great wise people at the top. But the Federal Reserve, as the post office can be a place where every American can have a financial account. Why not use our institutions in our country to give a break, not just to the people at the top, but to everybody? If you don't have a savings account with a local bank, for a lot of reasons, you end up paying a fee to cash your check. You end up too often going to a payday lender if something happens. How about we could have direct deposit at a postal center for you, at a post office, or at the Federal Reserve. There's no reasons, if we had a president and Congress that wanted to do it, that we couldn't start using these financial and these institutions in our country and they're not really competing with financial services. Huntington in Columbus, and headquartered in the city Dr. Hamilton teaches in, Huntington's going to do fine. Huntington doesn't spend a lot of time going to the unbanked. That's not where their profits are. But why shouldn't the unbanked have the same rights and responsibilities and opportunities as the rest of us? And that's one of the things. I mean, we need to be creative, especially next year if there's a new president, there's a new Senate. We need to be creative about using institutions that are out there serving the public to serve the public in other ways, and frankly, to serve more of the public. And that's an opportunity I think we should take advantage of and can in the months ahead and years ahead.
I mean, I'm with you. I mean, the Fed is the people's bank. It is, we don't conceive of it that way, but it's a public bank. And in the 21st century, everybody not having access to an account with the technology that we have, I think is appalling. And clearly we have the means to do so. Hell, when we're born, we're given a Social Security account. So it's not a stretch that we could.
And the Fed as a bank could sort of set the tone on privacy, that the Fed wouldn't ask all these questions, wouldn't need to ask all these questions to get all this private information and then sell it. We would write this legislation, and the Fed could do it in a way that benefited the public. It didn't, and because you talked about privacy. I know I'm jumping around a little bit. The privacy, it should shift. Our legislation shifts the burden from consumers to where it should be, corporations. And people right now, people don't have any power over their privacy. You either check a box, sign your rights away, or you go without the online service you need. And that's just wrong. There's no reason that the power of government can come down on the side of consumers and on the side of privacy, and on the side of the unbanked, instead of always being arrayed against all of them.
So you've both talked about a couple of solutions, and so I wanna ask both of you what you would add to what you've talked about already in terms of key solutions for kind of rebalancing, and ask in particular, so at the core of so many of the problems that you've both been talking about are systemic and institutional racism and policy choices that enable big corporations to extract wealth from Black and brown people and communities. And right now, technology, although sometimes it's held out as the solution to every problem of inclusion, is actually probably making some things worse. So what, to go back to that opening question, what policy changes do we need to end the extraction and to address the racial wealth gap?
Dr. Hamilton, you want to start on that?
Sure. And, I guess I'll start with part of the technology question and say that, in a profound way, technology can empower people, but in an equally profound way, technology can extract and exploit from people. So clearly we're going to need a role to both regulate and counterbalance to make sure that it's being used in a way that really is empowering. And, we can be specific, but I think the next fault line, as we think about terms like redlining and disparity and who's vulnerable, it is those that are economically and politically and stigmatized, that trifecta, that will be most vulnerable from extraction and exploitation. And this is not new, this is historical. So we can learn from the lessons of the past and reverse that past and make sure that going forward, we are active in ensuring that technology is used to empower, to offer more, not take. So that's a broad point. And then in terms of policies to address the racial wealth gap, of course, the most direct and parsimonious is reparations, and reparations has the effect of also having the full-throated acknowledgement of what took place in the past, not only to offer dignified explanations that don't blame the victims, like calling them welfare queens or deadbeat dads, but recognizing that this current infrastructure of inequality is rooted in a past of resource deprivation and resource empowering of some at the expense of others. So it would do that, and that spills over beyond Black people, but redefines how we think about inequality in general. But you know, that wouldn't be enough anyway, because we know that there's market tendencies that even if we were to make a payment of reparations that would address the racial wealth gap, as well as change narratives going forward, we would still have dynamics that would lead to concentrations of power. And then, you know, it might not be the case. When the country is ready to redress the sins of the past, that will occur, and I'm committed to it. And I think one day it will happen. I fully believe in it because I believe in justice. But what might be particularly more politically palpable in this current moment might be something like baby bonds. And, you know, baby bonds is basically rooted in the idea that everybody has a birthright to capital, that everybody has a nest egg, so that when they are a young adult, they have some resources by which they can get into an asset that will passively appreciate over their lifetime, like a debt-free education, like a home. What's the difference between a renter and a homeowner? A down payment. What's the difference between an entrepreneur and a worker? Some capital. However great your ideas are, if you don't have capital, you can't bring them to fruition. So that is what baby bonds is intended to do. It's really intended to give that nest egg, and it fits in with the American, again, this is very American. We have Social Security and obviously we need to strengthen Social Security, but to ensure that we have adequate finance and resource when we reach the twilight of our life, when we start to retire, because we recognize that people work hard. And I'm sorry for even bringing up that narrative of work hard. Of course, people work hard, but we have something that's reserved for people at the end of their life. But we don't have anything beyond subsistence for young adults that are starting a lifetime in which they need an economic foundation by which they can benefit from the asset security of something like a home, a business, or debt-free education.
And Lisa, it's about structural racism, as Dr. Hamilton said. It's also about corporate power. And one of the best, most direct, I like what he said about baby bonds, is something we can do now if we had the political will. Was similarly, in terms of checking corporate power and in terms of checking of beginning to dismantle culture, dismantle structural racism, is to pass the PRO Act, pass the bill protecting your right to organize, because we know the polling shows that I mean, every survey I've seen shows that a majority of Americans wish they would like to join a labor union. They know that in this pandemic, those with the carry a union card are safer at work and making better wages and better benefits. They know it's their way to achieve the American dream. They know these essential workers are mostly women and disproportionately people of color, the same people that are joining unions in large numbers around the country where they get an opportunity to. And we just say under the PRO Act and what government policy should be neutrality. People want to join a union, they ought to be able to. If they don't want to, they certainly shouldn't have to. That would begin to close a lot of these gaps. It wouldn't entirely, of course, deal with structural racism. It wouldn't entirely be a check on corporate power, but it would empower so many people that would make them more likely to vote, as union members are, would make them more likely to be able to buy a home because of the security of carrying that union card. And what Dr. Hamilton said is so right. The difference between a renter and a homeowner is the down payment. And with union wages and perhaps a credit union you belong to, you're more likely to achieve that. Or if you had your account at the post office or the local central Federal Reserve Bank.
Thanks. So I want to note that we're getting close to, we already passed when we were supposed to stop. But there, the conversation is just beginning. So before we tie it off, are there any last things either or both of you want to say? I burning ideas that we haven't even touched on yet to throw out there for the next round.
This is less an idea than a sort of frame of mind. This is the darkest time in my lifetime for our country. Clearly, it's the time when people feel the least hopeful. It's a time when so many people's lives have become undone, but it's also, I look ahead in the next few months and again, this isn't a political vote for the right candidate kind of event. I understand that, but I can see that there is a real mission now to deal with the issues of structural racism, to deal with wage inequality, deal with climate change. That all of them are intertwined, and I think there is a real reason for hope now that people understand these issues. It took the pandemic, coupled with the fact that every week almost it seems we see a video of a police officer murdering an African-American man usually, coupled with the fact we have a racist president. And I think all three of those have made white America look at this world very differently from how we did before. And I think that's a real call to action come next year.
And I'm gonna start with a joke and say, Lisa, what did you expect when you put a professor and a senator together? We're gonna go long. We got a lot to say. So, you know, I'd say that we're not atomistic agents floating around without notions of power by which some market mechanism will mysteriously sort us into deserving and undeserving and what's fair and efficient. I think that this conversation is recognizing that power has a lot to do with haves and have-nots, and that we have a public purpose to ensure that we're promoting shared prosperity. I think that has come up clear, and you know, I'm grateful to both of you and grateful for the senator for all the work that he does in pushing these bills. And the last thing I'll say is I'll end with optimism as well. I feel that in particular young people are pushing and making sure that we are focused on what is just, that notions of justice and morality are part of our economics, that it isn't just some self-interested notion of accumulation that knows no bound by which we can be persuaded by group privilege relative to another group. Instead, we're recognizing the common humanity in each of us and promoting sustainability and our shared prosperity. And I'm grateful for you all, and I'm also grateful for young people because the problems are as much political as they are economic.
Well, thank you both enormously for your time, your thoughts today, for the opportunity, you know, in the years leading up to this and in the months to come to continue to think with you and learn from you about these issues. And I really, you know, I hope for folks who are listening that we all can continue the conversation both about what the policy goals are and ought to be and how we work together to bring those changes about. So much gratitude, Senator.
Thank you, Lisa.
Professor Hamilton, appreciate it.
Thanks.
And we will switch ourselves out, and the next panel will be here in just a moment. So please hang on.
Thanks so much, Lisa.
Thank you, Senator. Thank you, Professor Hamilton.
All right, it looks like we have all of our panelists here, and since we are running slightly late on the beginning of this panel, I think we should start. My name is Marcus Stanley. I'm the Policy Director for Americans for Financial Reform. Just like to quickly introduce our panel. We have a very distinguished panel with us today, and want to thank everybody for participating. Pat McCoy is a professor of law at Boston College Law School and a former senior official at the CFPB. Marie Reinhart is a leader with the organization United for Respect. She's here to speak to the damage that private equity has done to our economy, which she has personal experience with as a former worker at a private equity-owned company. Maurice Weeks is the co-executive director at the Action Center for Race and the Economy. Mehrsa Baradaran is associate dean and professor of law at UC Irvine School of Law. She writes about banking law, racial inequality, and financial inclusion, and her most recent book is How the Other Half, or her two books, I should say, How the Other Half Banks and the Color of Money. Elizabeth Parisian is with the American Federation of Teachers. So without further ado, I just want to quickly note the order of our speakers. Marie Reinhart will go first, then Elizabeth Parisian, Pat McCoy, Mehrsa Baradaran, and Maurice Weeks will bat cleanup. So with no further ado, Anne-Marie, would you like to begin? Anne-Marie, I believe you're still muted.
Unmute. We got it. We got it?
Yeah.
Okay. Yeah, just a brief, I'm just kind of one of the phases of the damage that has happened with private equity firms and owned retailers. I'm one of 33,000 people that lost their job after 30 years with Toys R Us. I am one of millions of people now that are unemployed due to private equity driven bankruptcies. So I'm honored, and I want to thank you all just for even inviting me to speak about this topic. Do you want me to go on? I'll go on. I don't want to ramble. Now you're muted.
No, please go on to continue your remarks. I should say, overall, private equity is one of those issues that we're here on the 10th anniversary of Dodd-Frank. The Dodd-Frank Act was passed because Wall Street had excessive power and did tremendous damage to the economy. And for the Dodd-Frank Act did some good and positive things, but the truth is that we're sitting here 10 years later and looking at a situation where Wall Street still has excessive power and is still doing damage to the economy. And that's really kind of what brings us together to speak on this. And I think one of the failures and gaps in the Dodd-Frank Act is was its failure to take on the predatory business model of private equity, which in fact, since the Dodd-Frank Act, the size and power of the private equity industry has grown, not shrunk. So Anne-Marie, do you want to just continue and talk about what you observed as a worker?
Yeah, I wrote down what I wanted to say because I get to ramble. I'm so passionate about all this. And then obviously we know that there's a crisis in our economy, and it has been led by by Wall Street private equity firms. I myself have spent 32 years in retail, and I saw this crisis firsthand when my company, Toys R Us, was taken over by Wall Street firms, Bain Capital and KKR. Private equity firms buy out companies, they load them with billions of dollars of debt, and drive those companies into bankruptcy. They do all this legally for now. So that means after driving companies into bankruptcy, they have no legal obligation to their employees. When I did lose my job at Toys R Us after 29 years, my severance package was null and void, which I'd earned over 3 decades. We lose everything. We lose our income, we lose our health insurance, we lost our severance, which impacts our long-term financial security and our well-being. I was looking at retirement at my job, and instead in 2018, at 58 years old, I found myself back on the job market after a layoff writing a resume for the first time and unable to pay for both of my husband's and myself our prescriptions, and was terrified. So not only do working people in private equity owned companies face sudden unemployment, long-term financial hardship, but pension funds, which make up the largest investor group for private equity deals, they see poor investment returns after private equity owned retailers go bankrupt. Retail bankruptcy also reduces the tax bases and states for local localities. Private equity firms are everywhere. They own companies. They employ more than 5.8 million Americans. They are buying out hospitals, media companies, and retailers. In the past 10 years, almost 600,000 working people at retail-owned private equity firms and hedge funds have all lost their jobs. Over 700,000 indirect jobs have been lost to suppliers and local businesses, meaning that Wall Street's presence in the retail industry has led to more than 1.3 job losses in total. So this is why I came together with United for Respect and got together my Toys R Us coworkers and helped build a movement of retail workers who are standing against the destructiveness of Wall Street. We cannot sit back and do nothing as Wall Street takes over our economy. I know people who have lived through multiple Wall Street-driven bankruptcies, and I now work at Belk, another private equity-owned retailer. And at Belk, I've seen hours cut, full-time positions become eliminated, and the general practices that retail companies take to make their employees less secure. But when it happens in a private equity-owned firm company, there are added fear and these signs of impending bankruptcy and liquidation, which is a nightmare to work and to live through.
Thank you very much, Anne-Marie. And let's go on to Elizabeth.
Great. Well, first I want to say thank you to AFR for hosting this forum and inviting me to be a part of it. And I'm really happy to be here with all of the other wonderful panelists doing really important work. And I'm also from Ohio, so it was really nice to be part of to listen to the previous conversation with Senator Sherrod Brown and Dr. Hamilton. So one of the key problems with the way the finance system works now is how it functions to transfer wealth from workers to Wall Street, really at a scale that we've never seen before. And in the process, defunding the public sector and eroding public services. And I think this is especially problematic, not just because a strong public sector is what we need to provide essential services like education and healthcare, but also because public employment is what has traditionally created a place in the middle class for millions of workers, especially for workers of color and women. And the reason why I've identified this as one of the key problems with finance is because I work for the American Federation of Teachers. We represent educators and paraprofessionals in pre-K through higher ed. We represent healthcare workers and public employees, and the vast majority of our members participate in defined benefit public pension funds, which in total have about $3 trillion of assets among them. So our membership is very directly connected to Wall Street and the finance sector through their pension investments. And to give a quick example of how this works, over the last decade or so, we've seen private equity firms and hedge funds greatly increase their access to pension fund capital, and they charge pension funds exorbitant fees to manage this capital, and they do so while keeping most pension funds in the dark about how much they're extracting in fees. And what this has meant is that millions of public workers over a very short period of time have seen their retirement savings end up in the hands of some of the wealthiest people on the planet. And this puts their pension funds and their retirement security at risk. A few years ago, the AFT analyzed this and found that the fees charged by private equity and hedge fund managers to public pension funds is a very significant contributor to pension underfunding. So, under current rules, the finance sector is free to extract billions of dollars in fees from public pension funds every year. And they don't even have to tell the pension funds how much they're taking from them. Meanwhile, many of the alternative investment managers then use the personal wealth that they accumulate from managing public pension funds to advocate for policies that hurt pensions and public employees. So I should also point out that there are a lot of other ways that the finance sector touches AFT members' lives. In some cases, our members are employed by private equity. We have healthcare workers and a number of hospitals that are private equity owned. In K-12 education, for example, we have hedge fund managers using their personal wealth to fund charter schools. In higher ed, there are private equity firms that own for-profit colleges and university chains. And we also represent public employees across the country. So many of them are at risk of having their jobs privatized by private equity firms or other firms with Wall Street backing. So I feel like, the Great Recession, it wasn't that long ago. And it was during that time that we saw pension funds turn increasingly to hedge funds and private equity to try to make up for some of the losses that they suffered. And now, 10 years out, it's clear that the real winners were the alternative investment managers. And public budgets, funding for K-12 and higher ed in most states haven't recovered from the last financial collapse, despite some very good reforms like Dodd-Frank. So I think it's really important that we understand the key problems with finance right now so that we can address the current crisis we're facing.
Okay, thank you very much, Elizabeth. And Pat, I know you're going to turn to some other areas of Dodd-Frank, not private equity specific. So why don't you begin?
Great. Lisa and Marcus, first of all, thank you so much for inviting me to join today. What I'd like to talk about today is an issue that currently is somewhat flying under the radar, but it's to me very important, which is the very close link between the financial security of ordinary families and the larger systemic risk on Wall Street and in the financial system. So what I'd like to do is go back in time to 2008. Initially, the 2008 financial crisis was a crisis about the near collapse of the financial system. But as we all know, and as many people experienced, in the wake of the 2008 crisis, families suffered terribly. So think of these numbers. They're mind-boggling to me. 5 million households or more lost their homes to foreclosure. 8.8 workers lost their jobs. The median net worth of families fell about 30% for all groups from 2008 to 2009. But after 2009, Black and Hispanic families continued to lose wealth, unlike white families. For Black and Hispanic families, their net worth continued to fall an additional 20% from 2010 to 2013. And that wealth gap between white families and Black and Hispanic families continues to grow today. So this is a long way of saying that a stable financial system is critical to ordinary families' financial health, and it is even more critical for communities of color. So what reforms did Dodd-Frank make to make the financial system safer? One signal reform was that it created a new council called the Financial Stability Oversight Council. Among other things, the council can name, we call the word designate, individual non-bank financial firms for extra regulation by the Federal Reserve. This council can also make recommendations to other agencies to adopt systemic risk rules. In addition, Dodd-Frank tasked the Federal Reserve Board with systemic risk regulation of these designated non-banks and also of every bank. And there were many other important reforms. However, the Trump administration has sabotaged systemic risk regulation. One easy way to sabotage it is for the council not to meet. And so under Treasury Secretary Steven Mnuchin, the council has rarely met during the Trump administration. When it did meet, the council also released the last non-bank systemically risky firm from Federal Reserve regulation. So they've all been deregulated again. The council also announced, having done that, that it probably wouldn't designate any more non-banks as systemically risky in the future. Finally, any recommendations that the council might want to make to other agencies to adopt systemic risk rules are just advisory. And for the most part, the agencies who get these recommendations blow them off. So I think it's fair to say that under Trump, our system of systemic risk regulation has fallen apart. And it's something that we really must address. Thank you so much, Marcus.
I keep muting myself, then realizing I'm muted. Thank you. And Mehrsa?
Yes, thanks also for having me on. This is great. And, you know, I almost couldn't decide what to speak about because there are so many issues to discuss. I mean, so one is the privatization, the private equity, and just the financialization of the economy post Dodd-Frank. And one of the things that you're seeing, I mean, you saw in the, you know, several months after the crisis that the stock market is slowly rising. Meanwhile, our unemployment is rising. And if there isn't more help, it could be a catastrophe, as some have said. The way that this crisis has affected disproportionately Black and brown communities because they're essential workers, because they never recovered from the last crisis. And then just the way that, you know, PPE materials and hospitals are so privatized because they're short, you know, because it's all about a profit-oriented market. So those they're the larger trends, but I think ultimately I also want to focus on the smaller trends because those are places where you really see kind of the broader picture. So when Congress passed the CARES Act, there were checks that they wanted to send out to every American, which is a great idea, right? So we sent that out, but there's this one ATM machine in in Manhattan, it's called KeyBank, and there's been 3-hour lines outside of this ATM for the past several months, mostly Black and brown people, mostly workers, to get their unemployment benefits. And the reason they're at this particular ATM is it's the only one in the city that doesn't charge a fee. And the fees are, we're not talking about a $100 fee, we're talking about a $5, $3 fee. But that could mean the difference between, you know, a meal for many workers. And so as the Times reported, there's people biking in from Queens to save $3, right? So that is a problem of infrastructure and systems that we should have fixed long ago, but have left, and then the crisis just exacerbates these things. So why is it there a fee at these banks? And part of it is the payment system is a federal institution. If you were here with the Sherrod Brown and Darrick Hamilton conversation, they touched on this, right? The public option. So the reason why people are left out of the banking sector is that the tracks are public tracks, right? Through payments, through credit, but there's a toll, and the tracks are controlled by banks. We give banks and only banks the ability to process payments and financial transactions. Yes, you can have a Venmo app or, you know, fintech app, but that all runs through a bank. And if you don't have a bank account, you have to pay a toll to get on those tracks. And so large swaths of the population don't have a bank accessible because of the merger wave over the last 10 years. The last one that was approved a couple of months ago, BB&T and SunTrust, which created the, I think, 5th largest bank in the country. And the mergers have been approved just kind of pro forma. There's been no real oversight on that. So that closes up bank branches. People lose their bank, and then they end up having to go to a check casher or payday lender, or pay fees for all of their transactions. So those are big problems, and I can talk more about in the solution section. But these are places where really the legislature and the public banks, the central bank like the Fed, the FDIC, the OCC, and the Treasury can really step in. But fundamentally, and going back to the earlier point, we are under this illusion that the private market does everything better, and that banks are efficient and effective, and that big companies, their health means the health of the people. And what we're seeing is that it's quite the opposite. And so we really need a public, either public option or some oversight to demand that these banks end up serving our communities because they're getting so much public help. But I tend to favor the prior rather than the latter, because the latter has not been effective in the past. If you give banks a mandate, they will go around it in the best way that they can, which is very clever. So I can talk more about that in the later portion.
Great, thank you. And Maurice, why don't you close up the first part of the panel?
Sure. Thanks, Marcus, and thanks to AFR for pulling this together. And thanks to these other amazing panelists. In particular at ACRE, we focus on systemic racism and how it shows up in economic justice issues like taking on finance, and looking at how that impacts Black and Brown and Indigenous folks in particular. There's obviously, as we've already heard, no shortage of ways that the financial system targets every day, folks who are Black, Brown, and Indigenous in their everyday lives. We're about to go into a deep recession, or already in a deep recession or depression, and we know that these communities of color have not recovered from the last recession. In fact, there are few pathways for them to have even attempted to recover, as some of the former panelists were saying. So, one of the tricky things, and I, organized during the foreclosure crisis, so I saw this firsthand, when folks are foreclosed on, and obviously that disproportionately impacted Black communities, it isn't just a temporary thing. We hear that number, Pat brought it up, of 5 million, sometimes you hear 7 million. And what's really mind-boggling to think of is that every single one of those people had nothing after they were foreclosed on. All the equity that they put into their house, all that sometimes have been in their families for generations, they had absolutely nothing to show for it going forward. That means that they couldn't pull out stuff to get their kids to go to college. They couldn't pull money out to deal with a medical issue that popped up. And many of them right now are then at the whims of landlords, some of which are corporate landlords operated by finance. And they're all right now potentially facing eviction during this horrible economic crisis that we're in. So we see the system of wealth extraction that operates on several different levels at once. And it's very dizzying to the average Black, Brown, and Indigenous person who's being targeted at all of these levels. So housing and homeownership is obviously one aspect, and it's a very large aspect, but we also know that during the time between the last recession and now, finance, and specifically financialization, has been heavily invested in destroying what normal jobs look like and propping up this new type of economy, or gig economy. And that's a direct challenge to traditional labor and really labor organizing, which we know helped protect Black and Brown folks from some of the worst practices of corporate America. And, we've all sort of seen or us nerds have all seen the myriad of graphs that show the disparities between union organized Black and Brown households and those that aren't. And it's very, very real. And there's a reason that financial firms are pushed for types of labor that are harder to unionize or almost impossible to unionize. It's because it keeps their wages low. And we see that with these industries in which workers of color are more likely to be in contract or temporary positions, or to just be lower paid in general, no matter what position they're in. So there's a lot more that we don't have time to get into about how finance targets municipalities of color as well. So not just the individuals, but the actual municipalities. So, pushing this anti-democratic line that the only solution to potential problems that you have in your municipality is to go to finance. So don't worry about doing it through all of your government agencies. Goldman Sachs can come in and fix your budget gap. Goldman Sachs can come in and fix the problem of your parking meter, Chicago, and various things like that. There's just no shortage of ways that finance preys on municipalities of color in particular. But it really brings me to the overall observation that finance and financialization operates always on the path of least resistance. So for us at ACRE, it's no surprise that poor folks and Black folks and brown folks and Indigenous folks get the short end of the stick, because the system is built on efficiency at literally all costs, no matter what the costs are, even if they are people's lives. And that system was built inside of a country that is systemically racist to its core, founded on racist principles. So of course, finance would always target Black and brown folks the hardest. That's just sort of the nature of its actual existence. So I'm excited to talk about solutions, which I know we all have lots to, so I'll kick it back to you, Marcus.
Great, thank you, or not so great, but in terms of what we're actually talking about, but thank you. So I'd like to put out some questions to the panelists for our last. We have 25 minutes before our next panel. But Pat, why don't we start with you? And you discussed some of these issues around control of systemic risk and how we haven't really succeeded in addressing the problems that led to the last financial crisis. What are the stakes here right now today? Could we be looking at another financial crisis that sort of adds fuel to the fire of our current pandemic crisis?
Marcus, yes, I'm really quite worried about this. I think further the risk of another financial collapse right now is flying under the radar. But make no mistake, it's very real. In fact, this past spring, the Federal Reserve had to pump out billions of dollars to prop up credit markets when they froze to the pandemic. So that was the canary in the coal mine. That told us that the credit markets are very skittish about the pandemic and required a rescue from the Fed. It wasn't highly publicized, but there indeed was a rescue. My new concern is about the big banks. Big banks are in an increasingly vulnerable position. They are highly exposed to something that we call leverage loans, which were given for corporate buyouts, including buyouts by private equity firms. So once again, we see private equity coming in and taking out loans that have grown so large in size that they are jeopardizing the safety of banks. In addition, banks have a lot of exposure right now, both to home mortgages and commercial mortgages. And in fact, in the past 2 quarters, they increased their loan loss reserves for both types of mortgages. Now that sends a signal. That tells us that banks expect a spike in mortgage foreclosures as pandemic relief to homeowners and businesses dry up. And let me tell you, the very first major piece of pandemic relief is drying up this week. And that's the $600 a week in enhanced unemployment insurance benefits that jobless workers currently receive. If Congress doesn't renew that, jobless families will lose over $2,500 a month or more immediately. So we can just expect the dominoes to fall and both rental evictions and mortgage foreclosures to rise. Meanwhile, businesses have been ironically taking out even more loans from banks in order to stockpile cash. And we know that many businesses right now are very fragile. So as we all know, currently the next dogfight in Congress has begun over more pandemic relief. Whatever happens, and I'm not sanguine that it will be enough, it will probably be the last aid before the November election. Bottom line, our financial system is in a very fragile position, and I think things are going to get worse. I'm always accused of being a Cassandra, and unfortunately, I'll have to end on that note because I'm quite worried. Thank you, Marcus.
Right, pretty sobering there. Mehrsa, I wanted to ask you, as it relates to postal banking, one of the things that we've really seen there be a problem with in pandemic relief and in sort of reaching people has been that we've intermediated a lot of this relief, not the unemployment insurance, but a lot of the other areas of relief through Wall Street and through private banks. Do you think that postal banking could make a difference in how we responded to things like economic downturns and so on to make relief more effective?
Absolutely. I mean, for someone like me who's been saying postal banking for the last, I don't know, since 2013 or so, this is like exactly the reason why we need it, because we need to get, $2,400 just, this is money that we have to people who need it, and we don't have the tracks to do that. And so the whole idea of postal banking is you would just have a simple checking account at your post office. And you would be able to get the ATM there, get a debit card, which is what people use for Americans that make less than $50,000 or $50,000 or below, which is the majority of Americans. That's the middle class that we're talking about. We're not talking about just very poor people or people that live in banking deserts. This is a lot of people. Their debit card is their primary mode of access to the market, and so that alone would save them up to 10% of their household budget that they spend on financial transactions. I mean, think about 10% and what that could mean to your family's lifestyle, bottom line, right? And so that's one thing. The other thing, I mean, to bolster what Pat was saying about the coming collapse, I mean, the fact that the reason why the collapse was so catastrophic in 2008 and had to be bailed out was because we had these 5, 6 too big to fail banks. Their assets were very correlated. And then there was the AIG mess where everything, if you let them fail, it wasn't just the banks failing, it was everyone else. And the question should have been is how did we get here? Why? Why did we get here? And how do we roll that back? We did not do that in Dodd-Frank. Since we're 10 years post, the banks are bigger. They're more like failure. How do you say too big to fail? Right? They're still too big. They're still very, very vulnerable to failure. And there's not a doubt in my mind that if the things that Pat is warning about, which my money's always that Pat is right, which is really not comforting. But she did warn about the last crisis, and she was right. And I think there will be a collapse, but I don't think for 1 second that they wouldn't get a bailout again. I don't think for 1 second, because the Fed in the weekend after the stock market dip post-coronavirus unleashed every single tool that they used in the 2008 crisis over a weekend, all of it. And it's still ongoing. And so if there is a blip on the bank's radar, they will come in and support that. And so the question is, if we have a banking system that's private and the gains go to their shareholders, and yet the public is always there holding the bag, why do we need to go through them to do basic financial transactions? Why do we need them as an intermediary when we can just send it straight through? Call it a public option, call it a Federal Reserve Bank account, call it postal banking. I actually don't care. The point is that you need to have some public access to the public banking system. And I think now is highlighting why it's important. But over the last 10 years, there's been a bunch of us who've been kind of shouting this into the void. And the time to do it was 8-10 years ago. But now is the second best time.
One thing that just to build on some of the things you said, when we talked to banking regulators about the experience in 2008, one thing that we have heard from multiple people over the years is that we had no choice about these bailouts, because the nightmare was that people would put their cards in the ATM and no money would come out. And that would lead to basically the collapse of society. And why is that? The reason that a breakdown in like synthetic CDOs and complicated securitizations could lead to a situation where your ATM wouldn't work is because we've sort of co-located all our critical payment systems together with these intensely like bleeding edge, risky Wall Street trading operations. And we don't have any public capacity to make that core utility payment system work. outside of those guys. And that's why they can hold us up for money every time there's an economic downturn and they might get in trouble. So, and that's why it's so important to build public alternative institutions.
Marcus, could I jump in and just add one more thing?
Sure.
Which is that I mentioned earlier that after 2008, 8.8 million people lost their jobs, and that was over, a couple of years. Contrast it with this year. So far, 14.4 million people have lost their jobs, and we're only 5 months into the pandemic. So the stakes are even higher. Everything Mehrsa said, everything Marcus has said, the stakes are even higher this year.
That's right. Okay, so I just wanted to follow up on some of the things said by other members of the panel. Maurice, you mentioned some of the work that you're doing with municipal and local entities, states, cities, and so on, about the relationship to Wall Street. And obviously, one of the issues that's really been salient over the last couple months has been police violence, which is an issue that is handled at that state and local level. Do you see connections there with your work and your work on finance?
Yeah, absolutely. I mean, I think the two go hand in hand. So, calls to defund and abolish the police, which have picked up a tremendous amount of steam recently due to the uprisings in cities across the country, are really a direct challenge. We see them as a direct challenge to the way that racial capitalism works in this country. And, right now we're heading into this recession, depression. In the last recession, the safest place in a municipality around the country financially was police departments, because they didn't really have many cuts at all. They never get as much cuts as anyone else during austerity. And, we've seen lots of examples of them being bloated beyond belief. So, small towns with tanks to police their streets and et cetera. And, there's sort of that connection, and there's a direct connection that they really do partner with Wall Street and these banks constantly. And that's either through their donations. If you go to look at any police foundation, their top donors are always going to be the big banks. Or through bond instruments that the big banks help to facilitate that pay for police brutality and other malpractice, which ACRE released a report documenting. So yeah, I mean, abolishing the police and defunding them for us envisions a world in which really just property rights and the protection of business is not more important than the needs of everyday people. And that's really what we're also talking about when we're talking about reforming finance or creating a public financial system or moving towards a jobs guarantee or any of the things that we've touched on in the panel.
Thank you. We have 10 minutes left, and we have a great panel coming up next at 5 o'clock, which is going to discuss another kind of institution that we believe is really critical to rebalancing the power equation with Wall Street, which is a national investment bank or national investment authority of some kind to serve as an avenue for public investment, not just public financial services, as Mehrsa talked about with postal banking. So I really encourage folks to stick around for that. And in our last 5 to 10 minutes here, I want to go back to Elizabeth and Anne-Marie to talk a little bit about private equity, which is so much at the center of a lot of these developments. It's been an entity, private equity and venture capital has really fueled the growth of the gig economy, which Maurice talked about, and kind of disempowering people in their jobs at work. And private equity has also been a major contributor to this leverage lending market that Patricia discussed, because they have basically loaded up businesses with excessive debt and leverage and used banks to intermediate that. And this current situation with the pandemic crisis is potentially going to allow themselves to empower them even more. So Anne-Marie, just wanted to ask you, how is that working in the pandemic economy? How has private equity been responding in this current COVID moment to take advantage of this suffering and these disruptions?
Well, in the middle of this pandemic, private equity has led just another round of retail bankruptcies and layoffs. And it happens to be the year anniversary. Hold on, I wrote that down. This happens to be the year anniversary that last year we introduced, along with Elizabeth Warren, introduced the Stop Wall Street Looting Act. It's a federal bill that is developed by United for Respect workers that was impacted by private equity-driven bankruptcies. The legislation would stop Wall Street firms from looting businesses and destroying jobs for profit and being forced to share liability that put workers first in the event of bankruptcies. So this happens to be the 1-year anniversary. We introduced it last July on the groundbreaking legislation, and we're really excited that our community of members want to regulate Wall Street as it continues to grow. With the pandemic, it has just, including, I think right now one of our campaigns are with Art Van Furniture, PetSmart, Petco. They're leaving newly unemployed workers in long-term financial security. Retail workers are demanding that COVID protections from private equity firms who are the root of the problem. So not more than it's become more apparent, what is more important to private equity firm retailers, stores like PetSmart, Petco, who are owned by multi-billionaire private equity companies whose revenues have gone up during this COVID and have been taking advantage of the situation, making their employees work without proper personal protective equipment or giving them extra compensation for risking their lives. Not only that, both stores have done massive layoffs without any sort of severance pay, affecting thousands of families during a very difficult time. Employees are not receiving hazard pay, and they even went as far as to report that the animals in their store were receiving worse care. So as hardworking people are losing jobs, healthcare, private equity bank companies have received between $1.5 billion and $3.4 billion in the private protection program loans. So we know that private equity companies will try to capitalize off of any situation. They did it with retail companies, so it's no surprise that they're attempting and getting away with doing it during a coronavirus pandemic.
Okay, and I would just add to that private equity is unfortunately also deeply involved in the healthcare sector, which is on the front lines of actually treating people for this disease. And we've already seen cases where the wages of frontline healthcare workers have been cut back, and there are cases of profiteering in sort of critical areas like hospitals and nursing homes by private equity, which is really disturbing. Elizabeth, I wanted to ask you about something that came up in your in your discussion, that you talked about how union pension funds, which are really critical source of capital for private equity, and there's obviously a tremendous amount of money controlled by union pension funds, and this seems to be a little bit contradictory, because private equity has also been very involved with disempowering workers in various ways. Do you think there are ways that we can mobilize workers' capital to restrain or defund private equity, or what can be done in that area?
Yeah, that's a great question, and absolutely. And I think there are, in my role with AFT, I work with pension fund trustees. A lot of AFT members sit on pension boards as pension fund trustees, along with union members from other unions. And so, there are actual workers who are empowered to make investment decisions about how workers' capital is deployed. And so I can give a couple examples of this. I mean, I do think it's one of the most powerful ways that we can hold private equity accountable, right? I mean, until we get, the Stop Wall Street Looting Act, right, which will, be the federal legislation that we need to really curb the worst abuses. Right now, we are able to actually take issues to pension fund trustees who, a lot of them are grappling, you know, on the one hand saying, well, you know, we're invested in private equity. It's, you know, we make money on these investments, and that's part of our duty, right? To invest workers' money. But on the other hand, we're investing in things that ultimately harm workers. And you know, Anne Marie, of course, laid out the many different ways that private equity can destroy entire communities, right? So a lot of folks are grappling with this. I can give you one example. You know, Marcus, you mentioned private equity in healthcare. The AFT represents workers at a private equity-owned hospital chain called Prospect. Prospect is owned by Leonard Green, which is a big private equity firm. And you know, their business model is all about, you know, they buy up safety net hospitals and then, you know, close them if they think there's money to be made on real estate, which we saw just recently. They closed a safety net hospital in Texas and sold it to a hotel developer, right? And they're also, you know, in the midst of the pandemic, we're hearing from our workers at this hospital that, you know, they're having to reuse PPE for days or over a week, right? And that they have the feeling that their hospital is, that the private equity firm is kind of using COVID as an excuse to not invest resources in the hospital. And in the meantime, ever since, you know, under Leonard Green's ownership, Leonard Green has taken over $500 million in fees out of this hospital, right? And that's money that, you know, pretty obvious to all of us right now, that's money that could be going towards patient care, right, in the middle of a global pandemic. So workers from these hospitals have been talking to pension funds, right, and working with community organizations to kind of tell their stories and say, look, you know, we believe this to be an investment risk for you, right? And I think that that's, and it's true, like all of the, you know, these aren't just stories that kind of tug at our heartstrings, right? I mean, you can actually say, you know, when workers are being laid off or when a private equity firm is creating systemic risk and evicting people, I mean, these are all things that put pension fund dollars at risk, right? So pension funds have an incentive to address those risks, right? And we're seeing, you know, and I just gave one example of healthcare, but we're seeing lots of pension fund trustees bringing in private equity managers and really asking them tough questions, right, about their business model and making demands that they, you know, treat their workers better and, you know, cease their business practices, their most harmful business practices. And I think, you know, the AFT is involved in doing that work, as are many other unions and many other community organizations. So it's definitely an area where we can hold private equity accountable.
Okay, thank you, Elizabeth. So we're going to go to the next panel in just a few minutes, but I wanted to ask folks if they had final thoughts. In particular, I think about solutions to these various problems that we've raised, and we've heard some on that already from Elizabeth just now on organizing to defund private equity, from Anne Marie about the Stop Wall Street Looting Act, from Mehrsa about building alternative institutions that could provide public banking services. But does anybody, just because I don't want to end on as depressing a note as some of the things we're facing here, but do people have more to add about looking forward, what we can do and the real possibilities that may open up over the next year?
Well, as the official Cassandra, let me end on a higher note, which is this. I won't give any specifics, but there's obviously a need for across-the-board reform in many, many different areas. And we may have an astonishing, exciting opportunity to put those reforms into motion. So now is a very, very important time to get organized and to focus on what reforms are needed and to be heard. Thank you.
And I'll just say, Marcus, so, I mean, both on this panel and if you've heard me talk elsewhere, you know that I usually trash finance as much as I possibly can. But obviously it plays a facilitating role in the economy that's important. So I mentioned this kind of offhand, but pushing for finance to be basically a public, treated like a public utility. And I know that that sounds like a really, really wacky idea at this moment in time, but you know, if we think that we need this facilitating force, it's hard to reason with the history of what finance has done, especially to Black and brown people, that we should let some of the players who are doing it now continue to do it. So I'm hoping it's one of those pie in the sky visions that becomes true, which some of them do. And then in the meantime, you know, this is what I sort of usually think about as the most uplifting note about organizing around finance is that, you know, a financialized economy makes just a smaller group of targets for any number of campaigns that you're working on. So, you know, you take a company like Blackstone, and just off the top of my head, they could be a target in a student lending campaign, a housing campaign, a prisons campaign, an infrastructure campaign, healthcare campaign. You know, there are lots of different areas. So just think about, you know, just picture all of those folks who are fighting and organizing in all of those different sub areas coming together and actually demanding some of these reforms and demanding that they stop extracting money from communities of color. And, you know, there are lots of groups like AFR and Worth Rises and Private Equity Stakeholder Project and lots of others who are helping us push towards that. And that actually always makes me feel better whenever I'm down about financialization.
Thank you. Well, that's a pretty good springboard to our next panel, because Maurice mentioned creating a public option or a public utility element for finance, so we wouldn't be dependent on Wall Street with this relentless and implicitly racist logic of profit. So we wouldn't be as dependent on those actors. And Mehrsa has talked about public banking services on the especially on the retail banking side for ordinary people, and having that be a public entitlement. And our next panel, which is going to be led by Heather Slavkin, and have two experts on public investment, is going to be on sort of another dimension of providing a public alternative to Wall Street, which is the investment dimension and the investment side. How do we build a public entity and a public institution that takes on the challenge of long-term productive investment with the public good in mind, with both financial sustainability and the public good in mind, and really takes on some of these long-term investment challenges that Wall Street is completely not doing, and instead just doing financial gamesmanship instead of investing in communities, in the environmental transformation that we need, and in infrastructure and industry that we need. So that's going to be our next panel, and I want to thank all of our great panelists today, who I think did a terrific job on outlining the range of issues we face here. And I'm now going to turn it over to Heather Slavkin for the next panel discussion. Thanks, everybody.
Thanks all.
Hi, everyone. Thanks for joining us today. I'm Heather Slavkin Corzo. I'm the head of U.S. policy for the Principles for Responsible Investment. I'm really excited to be here with you today for this conversation. We have two leading experts who I'm going to introduce briefly and then turn it over to them to say a few words about the topic that Marcus set up for us so well. So today we're joined by Saule Omarova. She is a professor at Cornell Law School, where she specializes in regulation of financial institutions, banking law, international finance, and corporate finance. Before joining Cornell Law School in 2014, she was a professor at the University of North Carolina School of Law. And prior to joining academia, Professor Omarova practiced law at Davis, Polk, and Wardwell in New York. And she has also served as a special advisor for regulatory policy at the Department of Treasury. We also have with us Professor David Wood, who is an adjunct lecturer in public policy at the Harvard Kennedy School and the director of the Initiative for Responsible Investment at the Hauser Center for Nonprofit Organizations. His current projects range from work with pension fund trustees on responsible investment policies, mission investment by foundation endowments, research on the changing nature of the supply for and capacity to receive capital for community investment in the US, and a global survey of the relationship between public policy and impact investing. So I think we have a really great panel for you guys today, and I'm going to turn it over to Professor Omarova first, so she can talk a little bit about the policy idea, and then we'll hear from Professor Wood.
Thank you very much, Heather, and thank you everybody for joining us today. So as we are celebrating the 10th anniversary of the Dodd-Frank Act now, it's perhaps a good time to think about what the Dodd-Frank Act did not address. And one of the biggest issues that the Dodd-Frank Act did not address directly was this growing disconnect between the financial system that we currently have on the one hand and the real economy and the real economy's needs on the other hand. So right now we live in the world of a paradox where there is plenty of private capital is sloshing around in the financial system. Institutional investors are looking for ways to put their money to good use on the one hand. And at the same time, a lot of the good publicly beneficial projects and enterprises and firms in the real economy are not seeing sufficient influx of patient capital. And that's why private equity funds can get in and basically buy up a growing number of companies that otherwise simply cannot survive, for example. So it's a matter not so much of the amount of finance available for the real economy, but a matter of allocation. Who allocates that money? Who decides where that money goes? And this is where we have now to face a situation in which we really need a public platform, an institutional platform for facilitating the right kind of allocation. In other words, for helping all the capital, both public and private capital that we currently have or can generate in future without much trouble, to flow precisely into the parts of the real economy where that money can increase growth, generate new jobs, well-paying jobs, reduce poverty, reduce inequality, and make for a structurally balanced, environmentally sustainable, and shared growth for the entire society. So the proposal that I and my colleague, Cornell Professor Bob Hockett, have advanced a few years ago is that to set up a national investment authority as precisely that kind of a federal institution in charge of designing, financing, and implementing a coherent national program of long-term economic development with a special focus on critical public infrastructure projects that currently do not get financed in private markets or publicly. So the NIA, the National Investment Authority that we envision, will act directly in private financial markets. It will not be a regulatory authority, but it will be situated right between the Federal Reserve and the Treasury Department and effectively conduct the industrial policy determinations, right? What kind of economy do we need to have? What kind of economy should we have 10 years from now, 20 years from now? And what steps do we need to take today in order to make sure that that kind of economy actually does evolve? So the NIA will act directly in financial markets, not only as a lender and guarantor, kind of like the housing market government-sponsored entities, GSEs, do. But most importantly, it will also act as a proactive asset manager, as an equity investor, as a venture capital firm, if you will. Only the kind of venture capitalist that acts with the eye toward long-term public interest and public benefit rather than the short-term private profits and private benefits alone. In that sense, the NIA will represent really a powerful public competitor to private equity firms that currently hold monopoly on that kind of risk investment in big projects that we need to to finance. And the NIA will use a variety of financial techniques, advanced financial techniques, to effectively make it much more profitable, much more rational for institutional investors like pension funds and insurance companies and foreign sovereign wealth funds to help finance the large-scale, long-term public infrastructure projects and clean energy and public transit, affordable housing, affordable healthcare, and so on and so forth, that currently they simply do not consider viable, because currently those projects are not necessarily able to generate commercially palatable profits. So the NIA, for example, will set up funds like venture capital funds and will become the manager of those funds and solicit those institutional investors capital for passive equity investments. And then the NIA will select the projects that it considers the most beneficial for the public interest in the long term. And then that it would manage those projects through their lifetimes. But when the time comes to reward the institutional investors for their participation in funding of those projects, the NIA will creatively use its federal backing, its ability to be sort of the 800-pound gorilla public investor, in order to synthesize the types of returns to institutional investors that mimic the projected long-term estimates of what these great new publicly beneficial projects will actually generate for the economy for all of us in the longer run. And that's how it will help to democratize finance. That's how it will help to drain the capital away from the currently sort of popular short-term speculative investments or private equity type investments and into the kind of enterprise that we all need to happen and flourish. Thank you.
Thanks for having me, Heather and AFR. I'm delighted to be on the panel, and it's great to be with Professor Omarova, whose ideas I think are really important and very timely in the current environment. So I study the private investors who should care about this stuff, right? I study responsible investment, investors who think big structural issues like climate change, like racial justice, social cohesion, economic inequality are challenges for long-term sustainable investment returns, and that markets could be better shaped in order to deliver or sort of make finance and society run together more effectively. I think a national investment authority has real potential to make that happen, although there are also some dangers in thinking about this relationship between public and private investment. And in my own work, I guess, what I'm drawing from and talking about the sort of public finance side of this are the sort of potential for investors who care about environmental and social issues, the limits of what those investors can do, but also how we can reshape the system so that you don't have to depend on private action in order to achieve a public good. Private action leads to a public good. And I sort of, I'll just give you 5 things I think the authority can do that are in many ways just repeating what Saule said, but just to highlight what I think the functions of this thing are, and maybe we can go into some of those challenges afterwards. First, I think a national investment authority can give strategic direction to the market in a way that private actors can't. And this is true for institutions in the same way that I love Darrick Hamilton's quotation earlier on this, where he said, we're not atomistic agents with markets that resolve our differences. We have to think about power and public purpose. Well, in markets, we need an institution that thinks about power and public purpose, and a national investment authority can do that. And this industrial policy question that Saule brought up is really important. Secondly, we lack, and I think responsible investors would say, across the board, we lack long-term finance. We lack patient risk-bearing capital in the markets. Markets drive towards short-termism. They drive towards risk that isn't connected to long-term social value. And a national investment authority is a way to deliver that kind of long-term finance, but also to build up the muscle in government so that you are repeating those actions. We have like little bits and pieces around government that do these sorts of things, and concentrating the function of delivering long-term finance for public purpose seems to have a value in kind of learning by doing. Third, the National Investment Authority can be a focal point for infrastructure investment, economic and community development, affordable housing, climate-related investing, broadband into underserved areas, all of these things that we have different disparate programs for across government, but we can consolidate the finance side of those things and drive those markets, and ideally not drive markets that are carbon intensive or that are racially unjust. And I think the authority has the ability to do that. Just two more. One, I think the National Investment Authority is a place to set standards for what high road investment is. What are the criteria for good jobs and decent work, racial and gender and economic justice and human rights, decarbonization and climate resilience. If those standards are raised in the National Investment Authority and there's long-term patient capital attached to it, that'll change how private investors act. And the last one is, I think this kind of learning by doing thing is pretty important. You can have an innovation and research function within the authority so that the lessons learned about which sectors, which kinds of projects, which kinds of capital attached to which kinds of public goods are recycled into the market. And do something like what the Fed does for monetary policy and with its research arm, have that put into a National Investment Authority. I think that could serve a really powerful public purpose.
Thanks, Saule. Thanks, David. It sounds like a really interesting and timely idea. As you guys know, there's been a lot of conversation in Washington about stimulus. And of course, there's also been a ton of conversation about the importance to invest to create good jobs and respond to the pressing challenges that climate change presents for us. You know, another idea that we've heard a lot from folks for actually a long time now is the infrastructure bank. And people have proposed the infrastructure bank as a way to help to finance the investment we need in infrastructure. And so I'm wondering if you guys can tell us, is this the same? Is this just a bigger infrastructure bank, or is this actually something different?
So I think that this is building on an idea, the same impetus that the infrastructure bank proposals do build on, but takes it to the next level qualitatively. So typical infrastructure banks are usually designed to address a particular type of infrastructural problem, you know, typically some form of physical infrastructure. They're also typically funded through congressional appropriations, so their budget sits on the federal budget, and it's limited in the kinds of investments it can do. And typically infrastructure banks act through credit markets alone. In other words, just through loans, grants, maybe securitizing, maybe taking the first risk, tranches in various loan products, and so on and so forth. The NIA will, get past all of those traditional limits. And so the NIA will be acting not only in credit markets, but more importantly, in those markets where the risk-bearing, much more ambitious equity capital can be channeled and harnessed toward publicly beneficial purposes. And the NIA will use a lot more aggressive, proactive tools of actually getting inside the markets and getting inside the firms, the portfolio companies in which the NIA will invest, and start changing the relations within those firms as a shareholder, as a powerful player in the internal governance of those firms in the way that infrastructure banks are simply not set up to do. And also, the NIA will not have to focus only on funding projects like infrastructure projects that are commercially viable. In other words, projects that generate user revenues, be it tolls or be it some kind of other charges and so on and so forth. The NIA does not have to do it because of the structure of how it kind of sets up the system of risk and reward for the private investors. And therefore, the NIA will be able to finance greater social infrastructure projects that currently simply do not get off the ground.
Yeah, do you want me to answer, Heather, or should I?
Sure, go ahead.
I mean, I just totally agree. How useful is it when you say, oh, I agree. The infrastructure bank, it depends on the infrastructure banks, right? There are different designs, and some have a sort of more robust authority, and some are more sort of leveraging private capital or really giving away subsidies to private capital. I think it's very important to think about infrastructure as one asset class and one kind of money among many. Especially because infrastructure alone doesn't create the structural transformation we need, but it's super important to it. But so doesn't business lending, right? So doesn't social infrastructure as well as hard infrastructure. There are ways to, and project finance is not the only kind of vehicle that we could use to achieve the goals that infrastructure investment is trying to achieve. So I think this is a more robust version, but it also allows for a little bit stronger strategic policy.
I see. And so it's sort of on a related note, there's a lot of talk about public-private partnerships, PPPs. And so how is this different? Is this the same? Would this just be a mechanism to provide a lot of equity for PPPs, or again, are we doing something different here? Saule, David, what do you think?
So, you know, this is at some level, the NIA is a public-private partnership, except the core difference from all of the existing PPPs that we know and don't love so much is that the NIA will actually flip the model of a traditional PPP. In a traditional PPP, it's typically public money. The public puts its own resources on the line, and private management, private control. Private actors decide how to use that money, and then they skim off the top as much as they want, right? In this kind of a public-private partnership, it's the other way around. The private investors will passively supply capital, supply the funding, but they will not control and they will not manage the decision-making process. It will be the NIA. The NIA will choose what kind of projects will be worthy of financing and what kind of projects will not be worthy of financing. And that is the key difference between the NIA and the PPP model.
Yeah, we'll need like significant guardrails to guard against the kinds of PPPs that the world is littered with that just didn't work out. But I think one way to think about that is a lot of times in the PPP model of the last, 20, 30 years, how we want to sort of say it from the Washington consensus in development finance, the product is designed to deliver the rate of return that investors think they need, not to deliver the social good that the public is trying to achieve. And then you engineer and try to get as much public good into that project as you can if you're doing it right. We need to reverse that. We need to figure out what we want to achieve and then figure out the right kind of money that should be delivered and not try to adjust ourselves towards some notional rate of return that's being demanded by finance, but doesn't really work in the world for what we're trying to do.
Thanks. And, David, that leads me to another question. I wonder, it sounds like you're drawing a lot from your experiences in responsible investment as you frame how you're responding to these questions. And are there other lessons that we should draw from the experience of responsible investors as we think about what a national investment authority should look like?
Yeah, for sure. I mean, I think there's a lot to think about. I think responsible investment has done so much work in the private sort of conception of what responsible investment is experimentation around new kinds of information, new ways to target social goals, new standards, environmental and social standards that we can draw on that experience to build into a public investment that will have a little more teeth, right? Or have a little more effect on other market actors. One place where I think there's a lot to work with the information disclosure around decent work and labor standards around human rights, drawing on the guiding principles for business and human rights from the UN, ways to think about carbon, emissions that Carbon Tracker has developed. All of these give us sort of some experience to design the high road standards that a national investment authority can really drive into the market. The other thing I'll say is this sort of the anxieties amongst responsible investors, especially the big asset owners. So I work with pension fund trustees, with Elizabeth Parisian, who was just on, in the last panel, thinking about these sorts of things where there's a great deal of experience in that community and anxiety about the short-termism in markets and the way that investments that are being brought to them kind of undercut social value in order to drive short-term financial returns. And I think that kind of, that gives you the thing you don't want out of the National Investment Authority, right? The guardrails you want to put up so we don't do that. And then these environmental social standards give a way to design, I think, floors and attachments to investments that can make them more valuable to the real economy and people. The last thing I'll say is I think in the US, we have a very robust community development investment market that grew out of the civil rights movement and attached itself to banking. It is not perfect. But there are tons of lessons and tons of often underscaled actors or actors that are at a certain scale, but the National Investment Authority could really expand that that function that takes into account things like racial justice and inequality and geographic determinants of health and well-being in a way that, you know, we have information out there we can draw from, but we need to bring it into a central place that has a little more heft in the larger financial markets.
Got it. And this is a question for both of you. Are there other countries that are doing this really well right now that we should be looking to as we think about what we would encourage folks in the US to move forward? Saule, go ahead.
Well, I was thinking that David probably is better positioned to speak to.
Oh, I thought you were waving your hand.
Well, David's better positioned just to keep on talking. That's different from having something to say. Yeah, I mean, briefly, yes, there are national investment banks out there. There's a robust literature on them that I've been diving into over the last year. It's fascinating to think about what KfW in Germany, which was founded after the war, really to kind of deliver on the goals of Marshall Plan reconstruction, but has played a big role in economic development in East Germany, has played a big role in decarbonization, has become the major, you know, or one of the major small and medium-sized enterprise lenders in Germany because other parts of the market aren't doing that. That kind of what Germans call promotional bank, or we might call a national investment bank. It's a pretty good model. There's the China Development Bank, which has driven industrial policy in China, BNDES in Brazil. We have things we can draw from. None of them are perfectly adjusted to the US, but you know, they do offer really useful analogs, and especially along Saule's idea of this kind of robust number of functions, rather than just having an infrastructure bank or just having a small business lender. I think that's where we can turn to see how it works out in practice.
Yeah, and I completely agree with David. There are plenty of examples, like for example, Temasek in Singapore is one of the great examples of a state enterprise that is actively taking equity stakes in a variety of industries and so on and so forth. But the key here is that, you know, what we really should learn from all of these countries is the impetus, the mindset. The lack of fear of inserting the public interest directly into the functioning of the financial markets. In other words, not to leave it to some kind of a mythical hidden hand, right? That somehow a variety of disconnected private actions will produce magically public good. These other nations know that that's not how it works. And the funniest thing is that we'd forgotten our own American history. A lot of those nations actually learned, you know, this kind of impetus from the early American Republic, from the Hamiltonian kind of a tradition of a strong, not imbecilic federal government that actually, you know, creates strong national economic growth. And I think that's what we need to focus on, but to adjust it to our conditions with the fact that, you know, the US capital markets are the deepest and the strongest capital markets in the world. And we do have the greatest resource right now in the financial markets, which is the full faith and credit of the United States. And that sovereign full faith and credit, it's the resource that we are currently underutilizing in the public interest. And the NIA will be the tool that will allow us to really get the biggest bang for that buck by basically using it as the greatest sweetener for all the private investors to come in and do what we want them and what we need them to do, not what they think they want to do with it.
Great. Well, it's exciting. I feel like this is the start of a conversation that needs to be, you know, that needs to continue, and hopefully it will continue to get more into the weeds in Washington and among policymakers around the country, because it seems like this is really the idea that we need at this moment to jumpstart our economy and to invest in some of the critical missing pieces of our economy, including, like you said, infrastructure, green technology, health infrastructure, educational infrastructure. There's so much necessary investment right now. And so I'm so grateful to both of you for having this conversation. I want to give you each a couple of minutes in case you have any closing thoughts.
I'll go first so we can close off with the expert. I'll just add one extra thing instead of a closing thought. I think we shouldn't think of this as this centralized function that is the function for investment that's public, right? It's an enabler of all of these different strands. And one of the things I'm very interested in is the way that regional policies will be different, and all the tools that are in states already that can be expanded and supported. Economic development agencies, housing finance authorities, port authorities, all of these will have a new tool to extend their work. So it's not like we're just consolidating everything into one unit. We're building up a muscle that can support a lot of different activity. And given the structural change and given the scale and speed that we have to decarbonize in, and given the fundamentally broken nature of our, the distribution of economic, racialized economic justice in this country, we need to build that muscle.
And I completely agree with David, and he put it really perfectly. We do need to build the muscle for the public to reclaim its power and its proper place in the economy and in the financial system. And this may seem like too complex, too complicated, too big of a reform, but in reality, it is something that we simply have no other choice. We really need to kind of step up to the plate and tackle that problem at the institutional level. Otherwise, 10 years from now, we'll still be talking about the fact that there is systemic risk in the financial system, and the financial system is unequal, and the growth is inequitable, and we still depend on other countries for supply chains. So my hope is that the time has come for ideas of this kind.
Thank you, Saule. Thank you, David, and thank you to all the attendees and panelists we had today. As we wrap up, I want to give a special thank you to Senator Brown and Professor Hamilton for the keynote conversation at the beginning of our event earlier. Today was the second session of a series of events marking the 10th anniversary of the Dodd-Frank Act and thinking about what to do next to build a just financial system. We will continue this conversation in upcoming events, including one that we'll be hosting with Chairwoman Maxine Waters on August 4th for a keynote discussion followed by a panel discussion. Please check out Americans for Financial Reform's website. It's www.ourfinancialsecurity.org, as we'll be posting there the details for Chair Waters' event on August 4th and information about other upcoming events. And this concludes today's session. So thank you all so much for joining us.
Thanks, Heather. Thanks, Saule.
Thank you, guys.